Okay, let's just dive right in. For anyone who was watching the markets over the last, 48 hours, it wasn't just bullish.
No.
It was what a lot of analysts are calling a structural break. We're talking about that window, January 13th to 14th, where the entire market just pivoted.
It was violent. A complete shift from a defensive stance to this really aggressive, spot-driven accumulation.
And that pivot is why the central idea from our sources is so important right now. They're calling it bifurcated acceleration.
Exactly. Bifurcated acceleration. It's a great term for it.
It's a powerful term. So break that down for us. How is that tension, playing out right now? Because usually when you have this kind of massive institutional force hitting a massive regulatory threat, one side kind of wins out, at least initially.
Well, that's the thing. They're happening at the same time. The capital force is immediate. You see it on the chart. But the regulatory capture, that's a slow legislative burn. So you're in this high friction environment. You have huge institutional demand forcing the price up with, almost euphoric action. And at the exact same time, you have these very sophisticated legislative attempts at state control trying to capture the underlying rails.
So you have to look at both at once.
You have to. You have to analyze the price breakout and the long-term regulatory threat simultaneously because, honestly, they're feeding off each other.
Okay, let's start with the immediate action then, the catalyst. It was this staggering reversal in institutional capital that it crushed the bearish consensus.
Completely invalidated it.
So what was the exact sequence there? How did we get from that tight consolidation to a full-on breakout?
You really have to set the scene. Bitcoin went into that 24-hour window just compressed. It was stuck between, let's say, $91,700 and $93,000.
Right.
And every single analyst was watching that key resistance level at 94.5.
Oh.
That was the ceiling for weeks. The bears were just stacked there expecting a rejection.
And what knocked that first domino over? What was the trigger?
It was a macro trigger. Came in at 8:30 Central Time. The core CPI data, the inflation numbers, they came in a little softer than expected, 2.6% with headline at 2.7, and that was it. That was the risk-on signal the institutional algos were waiting for. It immediately lifted Bitcoin up to test 93,000.
So the Fed might have room to ease. That was the signal.
That was the signal. But that only set the stage. The actual breach, the big one, that happened later.
Okay, when did that happen?
That was around 18.00 CST. So U.S. market hours are closed, liquidity starts to thin out just a little bit, and this overwhelming spot bid It consumed all the offers at 94.5.
And it just exploded from there.
The volatility expansion was immediate. Bitcoin surged all the way to an intraday high of 96,240. That's a 4.5% gain in just a few hours.
That kind of velocity, that has to be more than just new buyers. That screams short squeeze.
Oh, absolutely. The market was completely geared for a breakdown. So when it broke up, you got this cascade of forced buying. We saw over $600 million in crypto liquidations across the board.
Wow.
And $290 million of that was concentrated just in Bitcoin short positions.
So with that scale of liquidations, how does that leave the market now? Is 94.5 locked in as support, or is there a risk we just give it all back?
Well, the good news is the structure looks cleaner now. And here's why. While the price was ripping higher, Bitcoin futures open interest actually declined.
Oh, that's interesting.
It is. It dropped from $31.5 billion down to $30.6 billion. A rising price with falling open interest is a classic sign of a short squeeze. It means it wasn't a bunch of new leverage longs piling in that can get flushed out. This was spot buyers taking out the leverage shorts.
So real capital commitment. And we saw that in the volume numbers too, right?
We did. Daily spot trading volume expanded by 25%, hitting $37 billion. That confirms genuine weight behind the move.
And that money immediately rotated.
Immediately. Ethereum surged 5.1% to reclaim 3,300. But here's the really critical anomaly. The part that points directly back to our bifurcated thesis.
The privacy coins.
The privacy coins. Dash rallied over 60%. Monero rallied 5%.
A 60% move in Dash is not just correlation, that's conviction. That suggests some very sophisticated players are already hedging against the regulatory surveillance we're about to talk about.
That's the ultimate sign of this high-friction environment. The market smells freedom being throttled, and it's placing huge bets on the assets designed to evade control, even while the big institutions are buying the regulated product.
So on the technical map, what's the new consensus? 94.5 is the floor.
It's flipped perfectly. That 94.5 to 95K zone is now the critical support floor. Bulls have to defend that. The path of least resistance now looks open towards that big psychological barrier at 100K.
And beyond that.
The next major structural level is the 200-day moving average, which is sitting way up at 106, 115.
All right, so let's pivot to the engine behind all this. Regulated institutional money, the ETF flow data was, it was just staggering.
Beyond staggering, that reversal was the primary engine. U.S. spot Bitcoin ETFs recorded $753.7 million in net inflows.
$750 million.
In one day. For context, that's the highest single-day figure since October of last year.
That's a tidal wave. And the dynamics inside that inflow, the so-called Fidelity flip, that's really telling, isn't it?
Yes. For the first time in a long time, Fidelity's FBTC actually led the market. They brought in $351.4 million. That's way more than BlackRock's IBIT, which had about $126 million.
What does that suggest?
It could be a specific reallocation of client mandates or maybe just some very large accounts executing through Fidelity's rail specifically. But the breadth is what really confirms the conviction.
Meaning everyone was buying.
Everyone. 0 of the 12 listed ETFs had net outflows. Even Grayscale had positive flows, which is rare. It was a true synchronized whole-of-market inflow event.
And that just creates a massive supply shock.
A huge one. Those inflows absorbed all the new Bitcoins mined that day by a factor of 16x. The demand simply crushed the available supply.
So the institutional put is very much active. They see anything below 90K as a deep value buy. But we're also seeing the corporate treasury game evolve now, right? It's moving beyond just holding Bitcoin to active M&A.
Right. We have to talk about the Strive Inc. acquisition of Semler Scientific. This is being called the new playbook.
Why? What makes it so different?
Because Strive didn't just buy Bitcoin for its own treasury. They acquired an entire publicly traded company, Semler, mainly to get its Bitcoin.
To get their treasury of...
What was it? Over 5,000 BTC. And this single deal vaults Strive into the 11th largest corporate holder globally. They now have more Bitcoin than Tesla.
Wait, let's pause on that. So Strive is essentially buying the Bitcoin and then plans to flip the actual operating business, Semler's healthcare company, to pay off the debt from the deal.
That's the financial engineering, yes. It's brilliant. Strive explicitly said their intent is to monetize Semler's operating business within a year.
And use that cash to settle the debt.
Exactly. They'll retire a $100 million convertible note and a $20 million loan from Coinbase. They were stripping the core asset, the Bitcoin, and using the corporate shell to settle the bill. It's an incredibly aggressive way to accumulate clean Bitcoin exposure.
That is aggressive. And at the same time, we're seeing the infrastructure side merge. You have traditional banking and crypto coming together with the old Glory Bank SPAC.
Yep. Old Glory Bank announced a deal with a SPAC, Digital Asset Acquisition Corp., $250 million pre-money valuation. And their goal is explicit. Be the first chartered bank to fully integrate crypto into daily banking.
And they're targeting a very specific group, which again, it just highlights this friction we're talking about.
100%. They are explicitly targeting the freedom economy. They're going after crypto users who've been debanked. They want to be the compliant onshore freedom off-ramp between crypto wallets and FDIC-insured bank accounts.
So the Fidelity flip proves the big money is here. But that money relies entirely on these regulated rails. Which brings us to the counterforce.
The legislative encirclement.
Exactly. While the price is surging, the long-term risk is getting tighter and tighter. I'm talking about the Senate Banking Committee's draft of the Clarity Act.
And we have to be clear about this. The analysis coming out of Galaxy Digital on this bill it's not hyperbole. They state this is the, quote, single largest expansion to financial surveillance authorities since the USA PATRIOT Act.
That is some heavy language.
For a reason.
So let's detail the core provisions, starting with what people are calling the Treasury's kill switch.
This is probably the most alarming piece. It's called a temporary hold. It gives the U.S. Treasury the power to unilaterally order any digital asset service provider, exchanges, custodians, you name it, to freeze transactions for up to 30 days.
And they can do this without a court order, without a warrant.
Without a court order. Precisely. It's a fundamental challenge to the entire permissionless nature of these assets. It just substitutes due process for executive power.
And at the same time, they're going after DeFi by targeting the user interface.
Exactly. The bill extends Bank Secrecy Act obligations to what they call distributed ledger application layers.
So in plain English, we're talking about the websites people use, like uniswap.org. They would have to act like a bank.
That's exactly right. The web-hosted front ends would be legally required to implement KYCAMA screening, block sanctioned wallets, and file suspicious activity reports.
They're trying to deputize the developers.
They're trying to capture the regulatory gap by forcing the UI developers to become compliance officers. And this would effectively split the global DeFi market into compliant and non-compliant zones, which again brings us back to why Dash surged 60%. The market sees this coming.
Okay, this also explains the intense political fight over stablecoins, specifically around yield. Tell us about this compromise amendment from Senator Alsobrooks.
Well, the banking lobby has been pushing hard to ban stablecoin rewards, arguing they're like uninsured bank deposits. So Senator Alsobrooks introduced a compromise. It prohibits paying interest solely in connection with the holding of a payment stablecoin. So passive savings account style yield is banned.
But there's a carve-out, a crucial one.
A very crucial one. Yield is allowed if it's activity-based, so derived from staking, liquidity provision, lending, things like that. It protects platforms that incentivize user engagement, but this battle is far from over. There are over 75 other amendments filed.
And finally, on the political front, we have this highly charged situation around World Liberty Financial.
You're right. Senator Warren has basically injected high-conflict partisan politics directly into the regulatory process. She sent a formal letter demanding the OCC delay review of World Liberty Financial.
And that's the crypto project co-founded by President-elect Trump.
Correct. She's calling the potential approval an unprecedented ethical breach because the president would be overseeing the very regulators who approve his family's project.
Which guarantees that WLFI is going to be a political lightning rod from now on.
A huge one. It forces every key regulatory decision into that political spotlight.
Okay, before we synthesize all this, we need to touch on the technical risks. Price can go up, but weak foundations still break. This isn't just a reminder, it's a critical risk that new institutional money often overlooks.
Two very clear examples in the last day. First, the Betterment data breach. This wasn't a hack of their core system. It was a social engineering attack on a third-party marketing platform, a soft target.
The supply chain vulnerability.
Exactly. They stole customer contact details and immediately started sending out crypto triple-your-money phishing scams. It shows the weakest link is often on the periphery.
And the second one.
A sobering reminder of technical debt. The Truebit protocol exploit. A $26 million loss.
What was the cause?
A classic integer overflow bug in a legacy smart contract. The really important detail is that the contract was compiled with an old version of Solidity, version 6.10, which doesn't have built-in overflow protection.
An expensive lesson.
A very expensive lesson on the immutability of code.
So let's bring it all together. We have the price engine roaring, fueled by over $750 million in ETF inflows, while the state is actively, and I mean actively, tightening the choke points.
That is the definition of bifurcated acceleration. The immediate path favors the bulls. That breakout above 94.5 has 100,000 in its sights. The market is aggressively pricing the asset, but it's discounting the capture of the rails.
So what should we be watching for? What are the key items on the watch list to see which side of this bifurcation wins out?
3 things to monitor. First, the Senate markup tomorrow, specifically that special measures surveillance clause. If the Treasury's temporary hold power sticks, that is massive.
Okay.
Second, look for sustained ETF inflows. We need to see them stay above, say, the $200 million a day mark to confirm this breakout has legs and wasn't a one-off event.
And third, you mentioned the Coinbase premium. Why is that so critical right now?
Because it validates U.S. institutional commitment. A sustained Coinbase premium means U.S. institutions are willing to pay more than the global price for immediate compliant access. If that premium holds while we're up in this price range, it signals continued conviction from the big players driving this.
Okay, a lot to watch.
Which brings us back to that anomaly we discussed, that 60% surge in Dash. And this is the thought I want to leave you with. If the Clarity Act succeeds, if it forces all US DeFi front ends into a fully compliant KYC-required zone, effectively capturing those rails, how much deeper will the demand grow for the truly permissionless protocols? The price surge in privacy coins tells us the demand is there. So what's the ultimate trade-off? Institutional adoption on controlled rails or true unrestrained decentralization? Something to mull over as the market pushes towards 100,000.